I know. Whoops.
Good morning. So Megan and I have been sitting here for about 25 minutes, which is absolutely, it does not happen. We're usually running in 5 minutes before, scrambling. Are you on yet? Are you on yet? So all of a sudden it was 10. And so we're both caught on surprise. Caught in surprise.
Caught by surprise.
Caught by surprise. It's all in word choice.
I know.
Word choice is everything.
I don't talk good.
This is how today's gonna go.
Yeah, I know.
Let's just be clear. So, all right, we're gonna get started. There's certainly enough to be talking about. And I wanted to start talking from a position of giving. If you watch my Tuesday live, which I do every Tuesday at 8 a.m., sometimes I bring guests on and sometimes we're just talking about the economy. This time I told my story. My husband and I are in the process of buying a fourplex and a single family in Kansas City right now, adding 5 more doors to our investment portfolio. And I talked the entire time, which was 18 minutes. So I won't do that. I will not do that here. We don't have 18. I got about 1. But it's really all about the fact that one person changed the trajectory of my life. And I told my story of a child of a single mom to where I am today. And that shift happened because one person decided that it was worth spending time with me, that it was worth imparting his knowledge into my lack thereof. And so that's the quote today, because that's the kick I've been on all week. So the quote is from Maya Angelou, who I absolutely love as well. She says, when you learn, teach, when you get, give. So what are you giving today? I think that this market, everybody's talking about what do you need to do? You need to do a video, you need to get back to basics, you need to start door knocking, you need to stage, you need to do all the things. But where's your heart? What's your why? Where's your passion? So that is what will draw clients. That is what will make you memorable, will bring you into their relationship, into their lives, so that you can be that one person that changes the trajectory of their lives, because I think real estate does that. So with that, Megan, what in the world is going on with real estate this week?
Well, it has been an interesting development. We've actually seen a pickup in the marketplace. And so when rates dropped a couple of weeks ago, a lot of buyers are starting to take advantage of the fact that we're in lower interest. What's 30-year fix today?
So we're sitting around 4.99. The national average is about 5.49.
Yeah. And so with that little dip in interest rates, it improved affordability. And with the dip in average sales prices just in the last couple of months, kind of returning back down to where seasonal transition happens. Again, our seasonal transition happened a little bit earlier this year, where it came down starting in about May. It started to fall for our average prices. And historically, average sales prices fall June, July, August, and September. Right. And so that's a normal seasonal cadence that we go through, but we're off by about 5 to 7% from where we were at peak pricing during the insanity that we saw from January through April. And so with that dip in average sales price and the dip in interest rates, it improved affordability. And so some buyers got back into the market, and I saw a big pickup in my personal orders. And so I'm back to where I was in the summer months again, after having kind of that lull go through July. I was really concerned in July.
July was low
looking
for
at
everybody.
what was happening in July. And I was like, oh my gosh, this is why I have savings. Like, thank goodness for that. So I'll be, fat through the winter months as well. But I was really concerned, but the market has picked back up again. Now kids are starting to return to school, and we're all going to be sidelined by kids heading back to school. And it's likely that we'll start to see a dip in the number of pending transactions going into the next couple of weeks. And certainly after Labor Day weekend, we end up seeing that the market falls back as we get into September, October, November, and December. And so I would advise you, if you've got a listing that's coming up, get it to market as soon as you can, because you want to take advantage of the largest pool of potential buyers that you possibly can. Right. And so it's important that you're getting your listings out there. If you can't get it out there in the next week or two, then waiting after Labor Day weekend. But September is one of the hardest months to sell a house in, because we have the most amount of inventory, and our buyer pool is really starting to drop off by the time that we get to September. By the time that we hit October, November, and December, our prices tend to stabilize at that point before we have our big market run up as we go into January through April.
Yeah.
Now, I've had a lot of questions about, well, should I list my home for sale now, or should I go ahead and wait until next
All the way
spring?
to next spring.
Should I
Right.
wait until next spring to list my house? And my question is, are they also buying in this market?
Mhm.
Because if you're buying in this market, now is a much better time to be a buyer in this market than it is to try and wait until next spring when you're going to be in a contingent and very competitive market situation if we see the normal seasonal cadence pick up. And I expect that inventory will start to fall off as we get past September in favor of people waiting to list until next spring. And so we see fewer new listings making their way to market as we head into September, October, and November. And so it's important, again, that you're getting your homes to market as soon as you can.
Right.
Now, this last week, we ended up seeing, and I'll go ahead and start pulling up slides here for you. Share. And so pulling up the slides, looking at what's been happening over the last couple of weeks, this is our heat map that shows what's been happening with our cooling trend and our heating trend. And you can see that this tracks the inflow and the outflow of new business, showing activity, days to equilibrium, it tracks price reductions, but it color codes everything in relationship to each other. Whereas when we start to see blue cells creep in here, that means the market is becoming less competitive. And every time I tack on a new row, it becomes less and less competitive. And our cooling trend really started to settle in around Easter this year. And so our market pulled back earlier as interest rates went up and we started to hit that affordability tipping point. And so again, with interest rates coming down in the last couple of weeks, it's been interesting to see that we've had a little bit of a pickup in our marketplace and it ended up dropping our month supply of inventory. Well, it actually held even. We're sitting at 1.3 months worth of inventory at this point. And so that means for every one buyer in the market, they have 1.3 homes to choose from. Coming soons also popped up this last week. We ended up seeing a 7.6% increase in our coming soons. Our average daily active count went up by about 12.2%. New listings fell by 2%. So it's not because we have a lot of new listings making their way to market that we're seeing inventory stack up. It's
Right.
because it's taking longer to sell those homes.
Yeah.
And it's taking longer to get enough showings to understand if you need to make a price reduction or not. And so earlier this year, when we were talking about price reductions, we knew that if you were on the market for longer than 1 week, with median days on market being at 4 earlier this year,
Right.
that if you were on the market for longer than a week, that you were probably overpriced and needed to make a price reduction really quickly. Well, now it's taking a lot longer to get those people through those houses. Median days on market is starting to stretch out. We have more supply available to those buyers. So it's important that you slow down the rate at which you're making your price reductions, because we're still seeing people that are cutting price reductions in week number 2 when they might not have had those magical 12 showings to get under contract. And so it's important that you guys are taking a look. Oh, you're not seeing the current slide.
That's what I just saw, people raising their hand.
Oh, whoops.
But oh yeah, it's stuck in the market
Let's
review.
try it again.
Thank you. It was the 4 hand raises that gave it away.
Yeah.
I was like, something's going on.
Yeah, hold on. Let's go back to this. Let's see if that does it. I feel like I'm kind of back in the same way where it's not going to show.
Yeah, it's go ahead and change the slide. Let's see if that changes it. That is so weird.
We'll see.
It's stuck in the.
We're checking to see what's going on here.
No, it's actually stuck in the presentation, which is really weird. Sorry,
Well,
guys, what are you gonna do?
We'll just do it this way then. So
Yeah.
then that way you can kind of see everything as I go through it. But this was the slide that I was showing to you where it was talking about month supply of inventory. Active inventory is up by 12.2%. Pending transactions this last week fell by about 0.3%. And so overall, looking at what's been happening this last week is we saw a stabilization point. And so over the last 4 or 5 weeks, we've been bouncing between 1.1 months worth of inventory to about 1.3 months worth of inventory. Is it still not sharing?
It's still not sharing. But you guys want to just look at us, right? I mean, I
know.
thought that was the deal.
Yes. Right? All right. So
All
let's
right.
see.
I'm watching. I'm watching on Facebook. You guys had me going.
Yeah. So we're taking a
all
look.
right.
So there we go. Okay. So we've got this up. We're just going to do it from this position so that
Okay.
it
Go ahead and
shows
change
everything.
it just so I see if it's moving. It is being stubborn. What's going on? You guys just might not get a slide deck show today.
That's not good.
It's not good. Oh,
Okay,
there we go. It is
now it's
going.
changing. Okay, great. And so month supply of inventory, I'm sorry, the odds of selling where I take into account all of the available homes for sale versus those that go under contract and or close in the same week. And then I project it forward for a 4.35 week period of time to cover the entire month. The odds of selling actually popped up this last week to 54.5%. So we saw that improve, which was great because we've been waiting for that number to rebound and we haven't seen it really rebound since earlier this year. Usually what happens is we go through 3-day holiday weekends or religious based holiday weekends. We end up seeing that the odds of selling tends to rebound, but this year it just hasn't. It's been sliding ever since we hit Super Bowl weekend. And so it's down now about 30% from where we were back earlier this year. Now the odds of selling is back to, and it's a little bit lower than where we were pre-pandemic, but it's on trend with where we would typically be seasonally for what we would expect. And so we're now looking back to about 2019 is where we are for in terms of the market. It's like, what does it look like now? And if you remember back in 2019, interest rates went from around 3% up to 4.5%. Right. And it slowed affordability down at that point, and then our interest rates dropped back down below 4.5% again.
All the way up to 4.5%.
Up to 4.5%.
Right.
I know, 4.5, super expensive, right? No, that's still a great interest rate in order to be buying a house.
And it's so lower than our 6%.
Yeah, it's lower than the 6%, but it did change
Yes.
affordability.
Yeah.
And so we ended up seeing slow depreciation during that time. But we're back to where we were in 2019, where we have some affordability issues on the horizon. Now, this slide I wanted to spend some more time talking about because I've been getting a lot of questions about this, and I'm going to write up my my email about this slide specifically as we go into this weekend. But I have a lot of conversations about people about what is a balanced market. And the notion of balance has an actual definition to it. And the notion of a balanced market is different than an average or a normal market. And so a balanced market occurs when the rate of appreciation matches the rate of inflation. And that tends to happen at about a 6-month supply of inventory. And so what this slide talks about is what would we need to get back to balance, not normal or average. If we were talking about a normal or an average market in Metro Denver, looking back historically over the last 15 years, we would need to have about 15 to 18,000 homes available for sale. That would create about a 3 to 3.5 month supply of inventory. But right now, to create a balanced market, which is the even playing field between buyers and sellers, and again, the rate at which inflation matches the rate of appreciation, to create a 6-month supply of inventory, we would need to have about 30,000 available homes for sale in our marketplace. Now, the last time that we saw about 30,000 active listings in our marketplace was 2004 and 2005. Right. In 2006, we actually had 36,000 available listings for sale, and that's the most we've ever had here in Denver. Before we went into the Great Recession, and so a lot of people are concerned about a recession and could that impact home values? And in this case, going into a recession would not impact home values in a significant way because we have too low of inventory. Back before we went into the recession last time, we had about an 8-month supply of inventory. So we had significantly more inventory in our market than what we do right now. Now, in order for there to be a recession that would affect home values, we need to have an oversupply of homes. So we would need to be north of that 30,000 number. We would need to have some sort of economic widespread hardship that causes a large jump in unemployment. We don't have that going on right now. Unemployment sits about 3.5%, so it's very low. We've got a big hunt for jobs right now for people to fulfill those positions, but we also need to have a lack of equity in our market.
Right.
Okay. We don't have a lack of equity. We've been watching near double-digit depreciation for almost 10 years in a row now. And so watching that near double-digit depreciation, if you've owned your home for more than 1 year, you're not going to be upside down on your house. Now, it's true that people who bought their house earlier this year, if you bought in January through April, you were paying premium prices for those properties while interest rates were going up. And we've watched home prices fall about 5 to 7% from peak values. So is it true that you could be underwater right now if you bought your home earlier this year? Yes. But again, holding in real estate is a long-term investment and being your primary investment. This is not a short-term investment. This is something that you're going to live in for 5 to 7 years on average. And so by that point, you're going to be right side up on your house. Truth be told, by the time that we hit April of next year, you're probably going to see price appreciation by that point as we go through our market run up that usually happens from January through April. And so again, by that point, you're going to be right side up on your house. The type of lending conditions that created the bubble last time with stated income loans, 0% down, 120% financing don't exist right now to create that bubble where homeowners are going to be upside down. People have to put a chunk of change down in order to get into a house. And so they're likely to have equity in their home by putting that down payment down, which wasn't necessarily required from the late 90s up until about the mid 2000s that created that housing bubble that we were in.
And we're having conversations right now about being in a housing recession,
Mhm.
right? Especially with the billing numbers that just came out this week, which we'll talk about in the second half. But that conversation is happening, and it has been happening, right? Everybody's been talking about a bubble. Now that everybody's talking about the fact that we are in a housing recession as dictated by the new build numbers that we just saw come out this week, more and more of that conversation is happening with your clients. You have to have these statistics.
Yes.
The statistics that we talk about in the second half and the ones that Megan is just bringing up, knowing what the average loan to value is now is 30%, knowing that we have double the equity that we had. You know, what other number just came out, which we haven't talked about in a while, is forbearances.
Yes.
0.7% of all homes, not even 1% of all homes are still left in forbearances. So the idea that people are going to foreclose is just, it's only if, as you mentioned, you bought a house in January through April,
Mhm.
you lost your job, which would be regretful. You were in a position where you couldn't afford to hold on to that home and you had to sell it. It might be a short sale. It's still going to sell fast. You probably don't have to go into foreclosure. And really, you have to live somewhere.
Mhm.
So why aren't you fighting to pay for that roof over your head? Because it will come back.
Right.
Yeah.
Right. And so I've had a lot of questions also about the number of foreclosures going up, and keep in mind that there was a moratorium on foreclosures for a long
Yes.
period of time. And so now those people that weren't able to pay their mortgage, or maybe coming out of forbearance and still can't pay their mortgage, we're seeing those numbers come up as a notice of election in demand. But again, the market is still hot enough that they're able to list their home in a hot market and sell that property and walk away with the equity and not take the hit on their credit. And so those properties aren't being taken back by the bank. The banks don't want to take back your property like they did back in 2008.
And they're not even
through
getting the
2010.
chance. It's just not even
Right.
getting there.
And so you're
Yeah.
able to list and sell your house very quickly. There's a very few amount of homes that are actually upside down on their property prices right now.
Yeah.
And so again, it's just not likely that we're going to see that type of recession hit in our marketplace. And so
Mhm.
as of right now, we only have 22.2% of the market that we would require to create a market imbalance. So this is, again, it's creating an inventory cushion for us. We have an equity cushion for us.
Yes.
And unemployment is really good right now. And so again, we're not likely to see this impact our housing values.
But people are seeing demand slow, and they're
Demand
seeing
is
their
slowing.
house sitting on the market for more than a weekend.
Yes, and
So
we're
it-
freaking out.
Feel
What are we doing?
like the bubble's about to burst.
Yeah, it's just
Right.
not the case.
No.
We're just returning to a more normalized market where we
Mm.
would see inventory hanging out, and the average days on market going back historically is about
Yeah.
30 days. We're still way south of that number. And so
Yes.
again, the market is still very good. It's just taking longer than one weekend to sell. So let's not panic, but it is taking a little bit more expertise to get your home under contract at this point. I'm seeing a lot more people take professional photos. You can't just do a drive-by shooting with your phone
Right.
out the window and
Yeah.
list a home for sale like we could earlier this year. So more professional photos, staging. I'm seeing people do mini flips on their homes before they get it ready to list it
Yes.
for sale.
Yes.
Going
I am
through
too.
and painting all of their house. They're
Yeah.
painting their house, cleaning the carpet, getting everything nice and staged.
Yeah.
And then I'm also seeing people do pre-inspections on their properties.
Yes.
And so a pre-inspection to correct any issues that a buyer might bring up at an inspection. I'm seeing home warranties being offered. I'm getting a lot more questions about home warranties and getting them hooked up with the reps at First American Home Warranty to get a home warranty in place.
And we're seeing a
For
lot of
that
seller
buyer.
concessions.
Yes. And so I'm
Yeah.
actually working on going through and re-exporting all of the data back to 2008 so that I can track concessions for you, because you need to be prepping your seller that there may be concessions involved at this
Mhm.
point. And so section 4.2 of your real estate contract is now coming back into play,
Right.
where we're seeing more sellers concessions coming up.
Yeah.
And so again, I'm going to go through and do that analysis. I hope to have that out next month for you, but I'm spending one day, I'm spending about 1 hour each day going back through and exporting about a year's
Oh,
worth
wow.
of data. So I have to build that back to 2008 because the way that the MLS system works, the fields have all changed. So I have to go back through and re-export all of the data. So I'm working on that for you. It's going to end up being about 1 million rows worth of data to sort through
Well,
in
that sounds
order
like
to go
fun.
through and figure it out. It's going to be great. I'm going to crash my Excel. And so it's going to be great. I'm going to love it. But again, it's just, it's a different market out there, and you have to be
Yeah.
preparing your sellers for the shift in the marketplace and prepping them that sellers concessions might be a real thing in this market. Looking at where we were for showings last week, the number of showings dropped down by 2.7%. We had about 14,000 total showings last week. We're about 2.1 shows per property. And so again, that's way down from where we were earlier this year during the insanity, where we were in January and February, where it was looking at 24 to 26 average shows per weekend per property. Now we're down to 2.1. So again, be preparing your seller that it's likely you're going to spend more than one weekend on the market. It's harder to keep your house clean for that long. I keep thinking about it and I'm like, oh my God, I only have my kids half the time. If I were to list my home right now, how would I get this? How would I keep my house clean with all of the toys that I have in my house for my kids? And so it's hard. It's hard to keep your house clean and show ready for that long of a period of time. But again, it's going to take longer. And so you need to be prepping your sellers for that. We're still sitting around 12 showings to go under contract. So about 12 showings should yield you a contract. So if you're getting 2 showings per week and it takes 12 showings to go under contract, you could be on the market for as long as 6 weeks. And so again, slow down the rate at which you're making price reductions. You don't necessarily want to reduce your price after the first weekend.
And you got to get in front of that too, because you got to think about what's coming up, like Halloween's coming up, Thanksgiving's coming up, and then
Mhm.
Christmas is behind it. If we're taking 6 weeks, I've got to start thinking about that. And I
Mhm.
can't, especially if you've got another house under contract and you want to sell your home contingent, you really do have to prep it even before you go out shopping for that home.
Yes.
So it takes more active communication. You just can't react in this market. You have to be proactive with those sellers and buyers,
Mhm.
helping them understand the changes that are happening.
Yes. Looking at median days on market continues to stretch out based off of data for units that went under contract last week. They were on the market for a median of 17 days. So that means that half the homes were under
Yeah.
contract in 17 days or fewer. The other half took longer than 17 days. And so we're looking at just over 2.5 weeks right now in order for a home to go under contract. So again, if you've had 2 showings per week, or if you've had a total of 12 showings and no offers, or you've been on the market for longer than 17 days, those are your 3 strikes where maybe at that point it's time to consider a price reduction. But
Yes.
don't make your price reductions too early, because again, you're going to cut your nose off to spite your face and you might end up leaving money on the table. Now, the rate of price reductions for last week was 45.6% of what went under contract last week had a price reduction. So we're starting to see the rate of price reductions. We've been watching it go up very steadily since Easter weekend, and now it's about 45.6%, which is higher than what we would typically expect for August. Usually in August, we see about 30% of them making price reductions. So the rate of price reductions has definitely gone up. Looking at the size of the price reduction also went up, where it's now a 6.5% price reduction, which is a big price reduction to go through and talk about. On an average priced home in Metro Denver, around $800,000, you're taking $50,000 off of that original asking price to get it under contract. So those are big price reductions that we're looking at in our market. Now, I'm running short on time, so I'm going to zip through the rest of these slides for you. The under $500,000 market, we're looking at 0.9 months worth of inventory. Our average daily active count rose week over week by 25.3%, and our pending transaction count fell by 1%, which is why our month supply of inventory went up. We're starting to see fewer new listings make their way to market. It fell by about 0.5%. Back on markets are also falling, where we're looking at about 94 back on markets for this particular price range. The odds of selling has started to stabilize in this market. We're now sitting at about 64.3% odds of selling, which is back to where we were pre-pandemic for about the same time period, where that's right on pace with where we should be. We're far from a market imbalance for homes under $500,000, where we have 14.6% of the inventory required to offset demand. In this market, we're also looking at about 3 shows per property per week. So that went down by about 24% going into this last week. And again, with kids going back to school this week, next week, last week, I'm not surprised by seeing that go down, because again, we're tired. Kids are tired. We're trying to adjust to our normal school season. Again, it's about 12 showings to go under contract, so you could be on the market for as long as 4 weeks. Median days on market stretched out to 12, so about half the homes were under contract in 12 days or fewer. So it's taking longer to get people through these houses. Looking at price reductions, it was nearly 40% of everything that went under contract in the under $500,000 market made a price reduction, and the average price reduction was 6%. And so that's holding pretty close to where we are for the average priced homes, but it's about a $27,000 price adjustment on a home for about 40% of the houses that are out there. For the 500 to $1 million segment, we're now sitting at 1.5 months worth of inventory. And this is one of our most interest rate dependent segments in our market, where it's about 85% of people that are purchasing between $500 to $1 million require financing to get into a house. Our average daily active count came up by 8.8% just this last week, and our pending transaction count fell by about 4.2%, which has led to this stabilization in our month supply of inventory as we get deeper into our winter months. Usually what happens as we go in deeper into our fall and winter months is this number starts to stretch out a little bit longer. So don't be surprised if it starts to take longer. Our month supply, or I'm sorry, our odds of selling has stabilized. We're now at about 52.2% odds of selling, which is back to where we were pre-pandemic in 2019. We're still far from a market imbalance where we only have 24.8% of what we need to offset demand. We have about 1.8 shows per property per week, so we'll call that 2 just to stretch it out a little bit. 12 showings to go under contract. So again, 12 showings to go under contract. If it's 2 showings per week, you could be on the market as long as 6 weeks. Median days on market was 18. So again, about 2.5 weeks for about half the homes to go under contract. We're looking at 49.8% of homes that went under contract last week made price reductions. We're looking at much more significant price reductions. And the average price reduction was about 6.4%, or about $48,000 off of the original price. Looking at what happened between 1 to 1.5 million, we're down to 1.6 months worth of inventory. It really popped up here over Independence Day weekend, where it came up to 2.4 months worth of inventory. And this number has actually been falling over the last couple of weeks, which is interesting to see. But that was down by about 10.6% week over week. Our average daily active count came up by about 12.4%, and our pending transaction rate went up by 25.7%. And so we saw a lot more units going under contract this last week for this particular price range, which drove our month supply of inventory down.
That does not surprise me.
Really?
Does it surprise you?
It was a little bit shocking.
I mean, I kind of
Usually that
feel
doesn't
like there's
happen.
just not a lot of inventory under $1 million, and are the buyers moving into Colorado expecting that? Especially the ones who are seeing this as an affordable metro.
Yes.
I mean, it kind of plays into that they're buying the $1 million to 1.5. I
Yes.
don't know. There's something to look into there.
The odds of selling is still better than where we were pre-pandemic. Pre-pandemic, we would sit at about 40% odds of selling. We're looking at about a 50% odds of selling right now for homes that are between 1 to 1.5 million. No market correction in sight. We only have 17.4% of what we need to offset demand in this market for a market imbalance. We're looking at about 2 shows per property per week in this price range. And again, it's about 12 showings to go under contract for the 1 to 1.5 million dollar market. So about 6 weeks on the market. Median days on market hit 21. So we're looking at about 3 weeks on market for half the homes to go under contract at this point. 47.1% of them made price reductions. And it was about an 8.3% price reduction for homes that went under contract last week, or about $115,000 off of the original asking price.
It has never been more important to price your home right the first time.
Yep. And if you price it
Wow.
right the first
Yeah.
time, it sells faster and for more money.
Yeah.
Keep in mind that if you're using comps from back in April when we peaked out in our pricing,
Right.
we're about 5 to 7% off. And we're seeing that in our price reductions with an average price reduction of about 6.8% right now. So you really need to pull back in your original pricing strategy. Month supply of inventory this week fell. Last week, it hit a high at 3.9 months worth of inventory. We're now back down to about 2.5 months worth of inventory, which is where we've been for about the last 4 weeks, with the exception of last week. We have about 210 active units in this market. And so that rose by about 3.4%. And we put 19 units under contract. So that rose week over week by about 58.3%. The odds of selling improved. We were looking at about a 39.5% odds of selling, which is about 7% higher than where we were pre-pandemic. So it's still very good. In this market, still no signs of a market correction. We only have 21.2% of the inventory required to offset demand. Showings are about 2 showings per week per property in the 1.5 to $2 million segment, but people are looking at more homes. So we're looking at 20 homes on average before going under contract. So again, you could be on the market for as long as 10 weeks if you're selling a home between 1.5 to 2 million. Median days on market was 17. It dropped down from the 29.5 that we saw last week. Price reductions were about 31.6%. So that came down this last week, where it was only about 30% of them made price reductions. And the average price reduction was about 10% off of the original price. So it was a $201,000 price reduction in this 1.5 to $2 million segment at this point. So again, we ended up seeing that there were a lot more price reductions that rolled through this week, and at more significant amounts as people become more motivated getting into the fall months, so that we could see so that we could see units going under contract.
So we've got some questions. Let's jump into these. I had to scroll through I can't see your slides.
Yeah.
It's like, no, I got that. We got that. Is odds of selling bound by the week timeline as a measure, or is it a measure of activities over pending?
So it's a measure of the inflow and the outflow of new business. So it measures pending and closed transactions for a given week against those that are active for the same week. And then I project it forward for a 4.35 week period of time, because that's how many weeks are in a month. So it basically projects out for the next 30 days, what's your odds of selling based off of this week's of activity.
And then Robin asks if it's worth advising a seller. We kind of covered that. Do you wait until next spring, or do you do it now? I really like the opportunities that the buyers have now. And then you have also less buyers. So if you stage it right and price it right, you're going to move it fast. If you're a buyer too, you've got an excellent opportunity, as we talked about. And here's the bottom line. Like, we don't know. Like, we can sit here and talk about and forecast what we think is going to happen next year, but I know what I have today. I don't know what I have tomorrow. And if your purpose of moving is to continue on with your life, like you need a bigger home for your kids, you need to move to a better school district, you want to have more backyard, all of those things. I'm like, why are you stopping life trying to time the market? Just live. And it takes care of itself so often. All right. So I'm trying to, okay, this is a little bit of a long one. I'm trying to square balance market figures. I think you said 2008, we had 35,000 homes. Now we've got 63, that's 23% of a balanced market. So you're saying if we got to 25,000 active, that our market would be okay or balanced, or was 35,000 too much?
So 35,000 would be too much. 30,000 is what we would need for a balanced market. And that's the rate at which appreciation matches the rate of inflation. For us to get back to a more normal or average market, we would need to have about 15 to 18,000 homes on our market, where we'd have about a 3 to 3.5 month supply of inventory in our marketplace. Again, balanced is different than average or normal.
Yeah.
And so I have this conversation all the time. I'm going to do a big write-up on it today when I send out my email, because we're going to go over this. We're going to get this one squared away. That's going to happen.
And then I think this, Patrick, was probably earlier, is to clarify, am I correct in saying odds of selling is a % probability of a listing will sell in 30 days?
Yes.
Okay. So then here's a new question. How do you quantify the effects of fear in the market to procrastinate future trends outcomes? In other words, even though there is no data to verify a market crash, yet can that data be skewed by an emotional component, created self-fulfilling prophecy?
I would love to be able to quantify the emotional response of people. There's no way for me to go through and do that. I think that we can track that by the rate of showings and the number of units going under contract each week, because that's what our buyer pool looks like. And our buyer pool is greatly diminished since earlier this year. And I think that that's more of an impact of affordability than it is due to fear. I think that this is a great opportunity for us to be stewards in the marketplace and to carry this information to our clients, so that they understand that now is still a good time to buy homes in our marketplace. And so again, you shouldn't be fearful about buying a home, but you need to be smart about what you can't afford and how to make that purchase.
And we're going to talk a little bit about that in the second half as well. Consumer confidence and its drive, and the watch of consumer confidence, which I was just watching a whole documentary on, like how consumer confidence got started. And they're very basic questions, and there's only a limited number of questions. I think it was like 5 or 6. And it was really how you feel about your finances. How do you feel about the future? It is trying to quantify that consumer confidence index. And the two consumer confidence indexes side by side, which I'm going to show you here in a minute, is trying to determine that. And yes, we are creating a little bit of a self-fulfilling prophecy by talking about the bubble and this recession so often. So I'm going to share my screen. I'm going to try this again. We're going to see if we can make this work. I don't know. And you know what? Ultimately, none of this matters. All right. So here we go. We'll see if we can see it on here.
I'm keeping an eye on it.
Right. Okay. So we started out with our quote. As a quick reminder, and we'll have the link to these. Today was the day that we were originally going to have Patty, but it was going to be a much smaller venue. Now we're moving it to the Field House, which is right near downtown, near the football stadium. So that is going to be 9 to 11, which is a little bit different than last month when we did it at the Country Club when it was 10 to 12. We're going to be doing breakfast and having Patty talk about the Denver level economics. You're going to want to hear this, and it's going to be limited because the building is a little bit smaller than Columbine was. And then Megan and I will go on Zoom. So we'll be live if you don't want to join us for Patty. but Patty, Megan, and I will all be live if you want to join us in person. So we'd love to have you. Make sure you've got February 2nd marked out in ink, not pencil. More information's coming. We're starting to line up the speakers, and I'm starting to get pretty excited. It is a one-day, trying to see if we can do this a little bit differently, get more people involved since we don't have a 2-day commitment. So we're trying it out. We'll see. We'll go back to 2 days if we want to next time. So let's talk about what's going on in the market. So mortgage applications, this hit headlines yesterday that the mortgage applications hit a 22-year low. Everybody was talking about the fact that we had the lowest. I'm hearing myself.
Sorry, that was me. That was me.
I'm on Facebook. But 2 of me is better than 1 of me.
Yes, I know.
Okay?
Well, I always say I need 2 of me.
I need 2 of
I
me.
need 2 of me.
All right, so mortgage purchase applications went to back to 2000, and so that was kind of a huge headline because that's going to fear. You have to think about headlines the way your sellers and buyers think about headlines. I'm asking you to commit to start reading these articles, not just the headlines, but actually the articles, and think about how is my consumer seeing this, and especially if they're not reading it, because they probably aren't. They're probably seeing the headlines, and start doing drips. Put it out on social, put it out on your newsletter, call your top clients, whatever that looks like. How are you feeling about this? How are you reading this? Because when they took this mortgage applications hit a 22-year low, it went over the broadcast is more like demand is like stopping, right? Like we haven't seen this since 2000. But if I break this down, a lot of this is the refinances. And that makes sense. So refinances were down, but purchases were only down, and they are still down. I'm not going to sugarcoat this. They are still down. They're down 1% week over week and 18% year over year, but they're down to levels that we saw in 2015. So not 18 and 19. We're still a bit lower than that. But come on, let's think about this for just a second. If I had already bought, I'm locked in at 2.5% or 2.625 interest rate. I don't need to go buy a move up home right now. I don't need to go buy a second home right now because I'm really good right where I'm at. And maybe some of those people that were first time home buyers, the ones that are taking advantage of today are amazing, the opportunities, but some of those can't, and affordability is an issue. So you've got a lot of things going into this, not necessarily negative, but just take things into context, right? So this is not buyers are not gone. Buyers are getting more discerning. Buyers are looking at, is it move-in ready? I want move-in ready. I want it exactly what we were talking about. Do the inspection report, fix those things, and present something that's staged well. Do the paint. My husband and I are talking about selling our house. We're already get a honey-do list. I was like, why didn't we do this 5 years ago and enjoy all this? No, but you got to do it right before you sell. So one of the big reasons, obviously, is interest rates, and we've all been watching this. So this is the last week. We've talked about how erratic the last week was with all the news. We have started to settle into a trend, and it's in the low 5s. Now, we talked when we first started the presentation, we're quoting anywhere between 4.875 and 5.125 for your typical vanilla 15% down conforming loan limit. You're buying different than that. It's going to be a little bit different, but that channel is narrowing. Now, if something breaks out, it's going to be a big breakout, whether it's to the downside or the upside. So we're watching for that to say, are there opportunities if we actually see a drop in the yields, or do we need to hold on tight if we see them to go up? But a lot of people are still saying, and I've gotten into a lot of battles lately, and I'm not afraid to do it. There's been a lot of social battles about thinking interest rates are going to go up to 7 or 8. You have to have a really strong economy to have an interest rate in 7 and 8. So the idea that we have a strong economy, I'm going to show you some of those metrics right now, and we don't. We still have a good economy. It's just slowing down. We still have jobs. They're just slowing down. We still have homes that are selling. It's just slowing down. We still have appreciation. It's just slowing down. We have to think about this economy in the context that's correct, not the context of the headlines. Super important, not only to listen to these and other podcasts and other articles, but to break it down for your clients, because remember, they're not reading everything you are. They're not in the housing market. We talked about this last week, and we kind of joked about it, that why doesn't everybody know everything that we do? Because they don't care, right? I mean, they're going to their job, and they're an engineer, or they're a nurse, or they're a teacher. They're not paying attention. Then all of a sudden they look up and they can't quite figure out what's happening. That's your job, is to make this relevant for them. So interest rates we saw. So a couple of people asked me, they're like, can I see what the interest rate is doing to home sales? Are we seeing when interest interest rates go up, are we seeing a massive drop in home sales? Or when interest rates come down, are we seeing a massive uptick? So we spent the time. Now this looks really erratic. Of course it does, because it goes back to 2008. So you're seeing each year's seasonality, which you would expect. So you just kind of look at the median, like this in the middle trend line, right? And so, yes, as interest rates were high and we were feeding off inventory and we were coming down off of the highs in 2006, we saw, and you have to think population gain. We've been seeing a lot of population gain and household formations here in the Denver market. And so we were seeing this small uptick of homes. And that's just, interestingly enough, during this entire period from 2013 to 2018, interest rates didn't move that much. I mean, yeah, they went up and down a little bit, but overall, that's a pretty static sort of interest rate line. And yet our home sales just ticked up just slightly. Now, when I look at this height of the interest rates, it went up, you know, what we were talking about earlier, where it went up to about 4.5. We see a little bit of a drop right here in sales, but it's not massively different. People in the Denver market did seem to come right back from that. But here's interest rates have spiked. We saw that our sales went up, taking advantage of it. Because remember, the interest rates, I've already been locked in 30 days ago by the time I've closed. So it's not a 1-for-1. You're thinking about a trend line. So I went up as interest rates were so low. And then we've dropped off significantly since then as people are adjusting to affordability. But when I looked at this, I mean, I see this spike coming out of COVID, and you see it, you know, down here where interest rates were higher and we had more inventory. And I'm looking at this, I'm like, overall, Denver's pretty consistent is where I like literally that was where I came back to. So yes, we have some adjustment period where we have to get used to this. And now that we're seeing the interest rates are kind of forming into this pattern, it's going to allow people to adjust. That's why I think if we do see this official recession and we do see interest rates drop at all, we're going to see people ready to jump because they've already adjusted. Now they're going to take advantage of it, which could mean the prices are going to continue to go up, if not faster, in the spring. And those people that are waiting are going to be behind the 8 ball again, because they're going to have to compete with other buyers for limited inventory, and those home prices are going to be higher. So Denver, when we were looking at, so a lot of people have been asking, do we see a population move, right? So the Census Bureau is not out yet. Redfin puts out a number of reports. You can get it from U-Haul, you can get it from Allied Moving Company, you can get it from Redfin. But when we're talking about this too, and I was looking at these closed numbers, Denver is in the top 10 of outflows. But when I was looking at this, it's not that different from where it was even last year. Of course, last year, things were getting more expensive, but this is just based on searches. So it's not yet based on the census data or the IRS data. So it's not, I don't want to say it's not fact. It's not full truth. It's just based on where people are searching, how many people are searching outside of the metro versus inside the metro. And I thought this was the most interesting thing at all. They're moving to Chicago. Who from Denver is moving to Chicago?
It's so cold there.
It hurts my nose, like
It's
way up in
so
here.
Cold. Those winters are terrible. You complain about a Colorado winter if you
I
go to
know,
Chicago winter.
Opposite.
I grew up going there winters and summers when I was growing, and it's awful. It is awful.
You got to find the joy in some of these, and you just got to post it. Like, who the hell, raise your hand. Who the hell's moving to Chicago? I don't know who those are. Existing home sales came out as well. In fact, that came out just this morning. And what I keep getting drawn to, so yes, sales are slowing down slightly everywhere, right? But what I came down to is nationwide, we're still up 10%. Now, this is slowing down. We just talked about this. This is 125 months of increasing, or not increasing, but positive appreciation. So the housing market is especially strong, right? But we see 10%. Last month, it was 13%. The month before that, it was 14%. It's slowing down. We're seeing that here locally as well, as we're having to do price reductions, as we see a little bit less demand, as we see even inventory slowing down, that we're still seeing the positive nature of this equity build. It's a long-term play. So the MBA economist Joel Kahn came out and said, if home price growth continues more significantly, right, and mortgage rates move lower, which we're thinking that could happen in the spring, we could even land a little bit lower if we control inflation between now and the end of the year, we could see purchase activity pick back up again. And I'm thinking if we're seeing purchase activity pick back up again before the end of the year, I don't think we're not going to see more new listings for that new activity. I think it's just going to soak up the active inventory. Do you think so too?
Yeah.
I think we're going to end up the year with lower inventory.
I do.
which is going to push us into kind of a seasonal year next year, which could be extreme again to some level, certainly not what we saw in 2020, 2021. Builder confidence also came out this week. So it was just a chock full housing week. Builder confidence dropped 6 points to 49. This is why we saw a lot more context and headlines around going into a housing recession, because now that it's below the 50 line, it's considered recessionary, right? And that's just an index. But builder confidence is slowing down, and we're seeing that specifically in the permits and the completions, and that those numbers just came out as well. But you've got to think about the fact that they are seeing people cancel contracts, they are seeing prices becoming unaffordable, and they were still dealing with high prices due to supply chain issues. So new residential construction numbers came out, permits are down, starts are down, completions are up, and we know why. Because they had a lot in the belly of the snake and they got to let it work its way through, but they're not starting new ones. Builders are allowing that inventory to work its way through the system. So completions are up both month over month and year over year, but permits and starts are down. And what really bothers me is the single family permits and starts are down even lower, which means that builders are really taking advantage of any equity or any revenues that they can create from the multi-level or from the multi-unit. Do we have anything that we need to answer? Or we're good.
No, I'm just kind of clearing stuff out.
Good.
Do you need to switch?
I just need to switch. All right. Redfin also came out with a report this week talking about the fact that home buyers are backing out. Of course, it kind of timed with the builders talking about the builder confidence being down, that people are backing out. They do a report looking at how many people as a percentage are backing out. And they don't look at that specific contract. They just say how many people went under contract in the month of July, how many people backed out in the month of July. So it's really just a comparative of that numbers. And so as they're looking at this, you were so funny.
Just clearing it out.
I know.
Clearing it out.
We're sharing our mouse right now. But the home purchases being canceled was at a record rate of 16.1%. Denver Metro was really far down the list. We were number 69 at only 13%. So if you look historically, that's pretty historical average. So when they talk about this massive number of people that are backing out of contracts of 16%, and you got to think about the average is more like 12.5 to 13%, it's all in relationship to what the historic average is, not necessarily the extreme that that number represents. And yes, it was one of the highest numbers outside of March because people backed out because they didn't know what the pandemic was going to do. But for Denver to be so low, it really does speak to the fact that people still want to follow through. They still do want to buy. They want to hold on if they can. So we were seeing only 13% of our homes backing out. They're also looking at a report of how many people have multiple bids. Now, remember, this is nationwide. Some of these numbers are Denver, but it's a comparison of what am I feeling here? What are other people feeling? And then what are the national numbers saying? So as Redfin was saying, the multiple bids are way off, right? Obviously, because we're seeing that there's a little bit less demand, soaking up some of that inventory. You're sitting on the market, days on market went up, all the numbers that Megan just went over. So we're seeing those multiple bids just recently in the last few weeks start to drop to 44% nationwide. Denver's at 37 per Redfin. Every data set's a little bit different, but compared to June, where it was 50%, or last year where it's 64%, so it's lower. So I started to think about this. What is that comparatively, right? Because should I get worried about a number of 44 or even Denver's 37? So interest rates are always going to affect people and their desire to either stay in that contract or bid up for that home. So we saw that drop more significantly, in fact, when we were looking back at 18 and 19, where people dropped from a height of 75% of bidding wars down to 13%. Denver at that time was 19% of people were going through bidding wars compared to the previous year. So the impact of interest rates is real. But I think today they still want to buy a home. They still understand the benefit of buying a home. They're still willing to pay the right price for that home. So staged right and priced right, we're still seeing demand and we're still seeing homes move. It's just taking a while for that person who thought that they could either overprice it or not do anything with it, that hoarder's house. So this was my break, right in the middle of the presentation. Okay, I work with buyers, not sellers, and I'm just going to say it honestly. I'm excited about this time. Like, I'm really excited and talking to all of our buyers. So if you want your buyer to be picked up and excited about the opportunities that they have and not scared, you're going to send them to me, because these are all the things that we're celebrating. And I know you love working with buyers too, and seeing them sitting at your closing table when they can celebrate less competition, more options, where they can bargain, where they can actually use down payment assistance in a VA or FHA loan, where they can do a 30-day close instead of a 10-day close, which absolutely stresses out everybody, where they can actually do it based on their home, contingent on their home selling, and negotiate based on inspection. Oh, the water line is broken and it has high radon and the paint is chipping. Oh no, that's okay. I'll take the house anyway. Right? But that's what you had to do for the last 2 years. And now you can hold a seller accountable to take care of the things that were possibly deferred when they're going to sell the home. I think it's fair. So we're working inside a very fair timing right now, especially for our buyers. So this is really cool. And then to have seen for the last 2 months, zero, I showed this last week, where we have zero low appraisals here in the Denver metro per FLS, Fairways Appraisal Management Company. Just really a fantastic time. So retail sales came out this week as well. All kinds of good stuff. Retail sales came out still strong-ish, right? So retail sales are coming down, but the core is still up. So the headline was flat. If you strip out autos and food and gas, it was still up 0.8%. And especially if it's priced right and staged right, or it's really fast and it's really pretty. Like those things are selling, right? People that have money are still buying. And those that were hit hardest by the pandemic, typically renters, are going to be feeling this, and my heart goes out. But people are still selling. So everything is still happening. The economy is still moving. It's just slowing down. This is what we feel when we feel like we're heading towards a recession. We start to feel this slowing down. We're just very attuned to what's happening right now. So retail sales, if I look at it graphically, it looks really good. Like it's still strong. It's still amazingly high, flat month over month, but still 10% over what we were selling or what we were buying, what retailers were selling last year. So when you look at that, and even online sales was up very strong. What was that? That was up 3%. So those numbers, and that was even just month over month. So online sales is up 3% month over month. Retail sales was up 10% year over year. Cass Freight Index came out this week as well. So this is looking at those shipments. So we talk about wholesale, we talk about PPI, we talk about retail, we talk about the CPI, we talk about these things from different perspectives. So the Cass Freight Index is typically a leading indicator. I talked about this a lot in 2019 as we were heading towards a recession. Anyway, we just got pushed into one with the pandemic, but the Cass Freight Index is starting to do the same thing everything else is doing. It was still ticking up, as you can see it here, but it's ticking up slower. So we're seeing those freight rates, we're seeing shipments, we're seeing all of the supplies at the shipping side of things, as far as the manufacturing, shipping, and then retail. All of that is also slowing up. Some of that is freeing up inventory, but you see these retailers like Walmart and Target, Costco, all are talking about the fact that they're not buying as much inventory. They're waiting for what buyers are going to purchase, trying to figure out what's going to happen during this recession. But every company that I keep hearing about that's waiting with this, trying to give up some sales to get rid of the inventory, hold on to the inventory they have, a lot of them are very cash heavy right now. The last 2 years were really, really good. We have really high savings at a consumer perspective, and we really have high cash values from a business perspective. So when we go into this recession, it's going to feel very different than the recession did in 2008. So this fear-based waiting is what's costing people from being able to not only move on with their life, but being able to capitalize on the opportunities. I mentioned this in the beginning. My husband and I are still buying real estate because I still think that there's opportunities for principal reduction and appreciation just lower. And I'm looking at the long game. That's the conversation that we need to keep having. Case Freight came out saying that we're coming into the peak season with just more capacity, more free capacity. This is going to allow a pullback in inflation, which is what we want, right? And could see a pullback in interest rates if we actually see this inflation number going down. Manufacturing survey came out this week. It dropped pretty significantly, 42 points. And that is really just saying that the fact that people aren't ordering as much because they're not stocking up. They're going back to trying to order it as they need it, right? And they're trying to sell out their inventory. They're trying to wait and see what's going to happen. And I'm going to play it a little bit skinny. I'm going to hold on to my capital reserves, but I'm not going to pump through a bunch of inventory through my system right now. So to see this, it just is another signal that things are slowing down. Initial jobless claims just came out this morning and they were down 2,000. So less people filed for unemployment than last week. And interestingly enough, last week they revised it down another 10,000. So those numbers still continue to be strong. We saw a downturn in our job openings and we saw our unemployment go down as we saw more jobs come online. We talked about that last week. And we're still seeing not a lot of people. We're seeing layoffs. I'm hearing about layoffs. I know it's all over the news, but those people are just going right back out and getting more jobs. So this is what we're seeing right now. Again, people are feeling confident going into this, but not as confident as they were. So that's what we're talking about, the consumer sentiment index and the consumer confidence index. So the consumer sentiment index is low right now because people feel like things are costing them more. They're feeling not as secure about the inflation. The consumer confidence that talks about jobs is still okay. Yes, it's down from when I could go and I could get a raise and I could go find 10 jobs. Yes, it's taking me a little bit longer to find a job. Maybe I won't get that raise, but I'm still finding jobs because the initial jobless claims are not going up substantially. So that's why you're going to see a difference between consumer sentiment and consumer confidence. They both have a limited number of questions. Those questions have not changed in decades, and they're just specifically about how that consumer is feeling about inflation, the cost of things, their wallet, their financial picture. And then the consumer confidence is more about their jobs, the ability to find another job, and how happy they are in their current job, and if they're willing to or able to get raises. So it's the difference in the questions, which is the difference in the two. So the consumer sentiment index does really track with whether or not we head into recession. So it tracks with the GDP. So that's why Powell talked a lot. If you watched him, when was that? That was at the end of July. If you watched him at the end of July, he talked about the fact that we want consumers to feel like we're doing the right move. He's been proactively raising the Fed rate high because he needs consumers to feel like we're controlling inflation. There's a big part of that. In fact, Fed chair says the public generally sees, and I don't know that I agree with this statement, but the public generally sees the Fed is very likely to successfully get inflation down to 2%. Now, based on the consumer sentiment index that I just showed you, I don't know that I completely agree with this, but this is what he's wanting. He needs that because he said, this is the key to the whole thing. It's not even about the GDP and is it negative, but it's about how people feel about the GDP and the success of the economy that's going to push us into this recession, the self-fulfilling prophecy. So we're going to run through the last of these in a couple of minutes left, but they did, both of us were commenting on this white paper that the Fed put out talking about the fact that they feel that they are controlling demand by raising rates and that it's not inventory, but it's the demand. And I showed you that chart earlier where it's like, yeah, interest rates matter, but consistently people are buying. And in fact, in their own report, they showed the exact opposite of the months of inventory. So how much inventory did I have based on how many the home price growth? But in their paper, they literally were saying that it's all really tied to the interest rates. In fact, a change of 1% in interest rate equals a change of 10% in demand. Now, having said that, we've seen rates go up 2.5%, where purchase applications are down 18%. So if you want a formula, that would be the one. Fed officials, the meeting minutes were just released. They just simply said that they are going to continue to use facts-based information. They're going to continue to raise the Fed rate. They need to be strong in the eyes of the consumer to control inflation. And lastly, I'm going to kind of land this plane with something that I saw that came out. Grant Cardone just came out as well. So that was on Friday, talking about the fact that don't buy a home unless you can absolutely afford it and can afford to waste your money. Now, Grant Cardone, if you watch YouTube videos at all and you don't pay for YouTube, which I don't, then you're seeing Grant Cardone videos all over about investing in real estate. Now, he's talking about your primary home. Of course, earlier this year, he bought his third primary home. We're not even going to talk about the fact that he's kind of talking out of both sides of his mouth. But when he broke this down, and this was picked up by CNBC in his whole article that went out on Friday, he said that if you make a profit you might think that you put a little bit down, you made an awesome profit, it's a return on investment. So it's, you've made, but he goes, but you've paid the things, you've paid the interest for 10 years, you've paid the taxes for 10 years, you've paid the real estate fee if you go to sell it, and all of these things, and you've had to maintain it. He goes, so you're not making any money. Your primary home is your worst investment. There's a lot of people talking about this right now, and they're talking like this. So they might not be quoting Grant Cardone, and they might not be quoting this article, but they're talking about the fact of it costs money to maintain a home. It costs taxes to maintain a home. It costs interest to maintain a home. But the opposite is rent. You have to have a roof over your head. And as I look at this, if I didn't purchase a home and I paid rent, I would spend in the same 10 years, $237,000 if I got a rental of $1,500 10 years ago based on rent inflation. It's perspective. So when we see somebody that throws out numbers like this, and we think the alternative is this, in fact, Gary Vee came out and said, you shouldn't be buying a home. You should take that down payment and start a business. And I keep coming back to this. Real estate isn't about the money. It's about options. It's not about the fact that I've got to put a roof over my head, so I've got to pay rent, or I've got to pay rent. It's not about the fact that I could take that down payment and I could start a business, or I could buy a home. I get all of that. But if I put the minimum down and over the next 10 years, it raises so that I can pull out that money cash free called equity, that is about options. It's not about making the dollar work after 10 years, how much did I spend on that home? It's about the fact that I'm paying for a house, calculate the alternative or the opportunity cost, which is rent, allow for the fact that you have tax-free benefits of cashing out or 1031 exchanges or passing on that home to your children without any taxes, and the fact that you can tap into that equity. It's not about money. It's about options.
Mhm.
We have to continue to change our story.
Mhm.
I think we nailed it. It's
Yep.
11 o'clock.
11:01. We're
11.
over time. So thank you guys so much for
Yes.
tuning in today. We actually had some questions. If you guys need to drop off and sign off, we'll go ahead and send out the recording for you guys later today. Why can't I get over to the other screen?
Oh, here.
There it is.
There's-
Okay.
okay.
So some questions. From Brian, curious if you know how the luxury or second home resort market is doing this summer. Summit County nationwide are buyers who need loans, say under 2 million up or down in mortgage applications. Do you know?
Our buyers need loans staying under, I don't know how the luxury are. Do you?
No, I don't know. I don't know.
Mhm.
Builders substantially lowered their co-op fees, so some realtors are not interested in new homes.
I would think that that's going to change. They're going to start dropping prices. They're going to start providing the basements.
Incentives
Yes,
again. Yeah,
yes.
we're starting to see some of that. Sometime could we do an update specific to attached and condos? Yes, I can actually do that next week for you so that you guys have that information. It's interesting. The attached market is actually faring better than the detached market right now, where it's more competitive for an attached property, with the
At the
exception
lower
of
price
Lodo.
points or everywhere?
Up to $1 million.
Up to $1 million.
Up to $1
Okay.
million. Looks like the next big thing finale. Yep. Our buyers don't have to do a free 60-day post to closing.
No, they
This is a
don't right
lot
now.
of chat window stuff. It seems like our chat window was disabled this month. Let's see. What are your current FHA rates for the buyer having 3.5% down, 680 plus FICO score, and front and back ratios with FHA guidelines?
Patricia, if you email me, I'll get you what that rate is. I don't have it off the top of my head and I don't want to misquote.
Great
Yep.
work, and slide decks will be emailed, so
Yes.
we'll go ahead and get those out to you. I've got another meeting from 12 to 1, so I'll be getting those out around 2 o'clock today for you guys, so that you guys get everything that you need in order to head into the weekend successful, as we always want to make you successful. We are here
Yes.
to make you make sure that you're able to better advise your buyers and sellers. We certainly hope that if we're able to help you better advise your buyers and sellers, that you'll return the favor and you'll work with Fairway Mortgage, and specifically Nicole Ruth and
Yes.
me, Megan Aller at First American Title. So let us know what we can do to help you out, and we will see you guys next week. Have a good one.